this video, I'm going to show you how to add finance into your development project in Aprao. So to start with, you can see that our total development costs, including finance here, is 16.02 million. Our total borrowing is currently 0, and our developer's equity is 100%. So the first thing we're going to do is we're going to add a lender. Let's say that this lender is our senior debt. This basically just means that it's your main bank, the person or the bank providing the majority of the money, but you can give it a name to suit whoever you're working with. Then what we do is we set the total loan as a percentage of either the gross development value or of the total costs. Next, what we're going to do is work on the interest. We've got a few options here, which may appear complex, but I'm going to speak you through it, and it's not that bad. So we've got the type. So the type here, it gives us 3 options. We've got interest on drawn balance, interest on the full loan amount, or profit share. So interest on drawn balance basically means that you only pay the interest on the money that is being used at that moment in time. So when I click onto that, that's the most typical for senior debt. Here what we then can do is set an interest rate. We can set interest rates either on an annual or on a monthly basis. We can choose then the type of calculation for our interest. Once we've done a cash flow forecast, we're able to get a really accurate interest estimate. But right now, we've got just our high-level estimated interest, which works using an algorithm that simulates an S-curve. This S-curve assumes a standard construction phasing over the term that you've set and will give us an accurate estimate of interest. Obviously, once we've done a cash flow, that will take it to the next level of accuracy. But for a high-level residual appraisal or an initial appraisal, this is a great place to start. The final thing here is being able to choose between retained, rolled up, and serviced interest. I'll just explain very quickly what they are. Retained actually allocates part of that total facility to cover the cost of the interest. So what it means is that there's a little bit less money available for the actual project because the lender is essentially lending the money to cover the interest. Rolled up interest, however, doesn't set aside a pot of money to do that. Rolled up interest is calculated on an ongoing basis, but it's only paid from the sales proceeds at the end of the project. And finally, we have serviced interest. Serviced interest is where the interest payments are actually covered out of the pocket of the developer throughout the life of the project. That might be on a monthly or on a quarterly basis, but either way, it has to be covered as equity in the project. For senior debt, I'm going to leave that as retained. Now what we've got are the fees. So different lenders charge different fees. By default, we have a commitment fee and an exit fee in here. We can set these either as an amount or as a percentage of the gross loan or a percentage of the GDV. For now, I'll work on the assumption of 1% of the gross loan in and 1% of the gross loan on that exit fee. We can choose whether that fee is paid by either the loan itself out of the equity or it's paid by the sales. So let me give you an example. That commitment fee is most likely going to be paid either by the developer's equity or out of the developer's pocket going into the project, or it's going to be paid by the lender at the beginning of the project. So that's either going to be from the facility or from equity. But the exit fee is only going to be paid from the sales proceeds at the end. So nobody needs to put that money into the project. It's going to be paid from those sales proceeds at the end. So we can choose from sales proceeds to allow us to do that. So now we've added in our first lender. You can now clearly see we've got our total costs, our borrowing, and our equity. But now let's say we want to factor in a mezzanine lender. So what we're going to do is add in another lender, and we'll just call it Mezzanine. Let's say that this mezzanine is 2.2 million. The mezzanine is going to be charged on a full loan amount, and we'll say that the interest rate is 1.2% per month. We'll assume the same term of 24 months. We've got an estimated interest figure, and the interest payout method is going to be rolled up because that's most typical with mezzanine. let's just say we have 1% commitment fee on the mezzanine loan, which is going to be paid out of equity, and no exit fee. So now what we've done is we've added in the senior debt and the mezzanine, and you can see now what's happened is the total development cost is being funded, £14 million of that is being funded by borrowing, and 2.8 is being funded by the developer's equity. There's one last thing I'm going to show you on this, and this is the forward funding. So if we've got an element that we would like to exclude from the financing, we can use this tool to strip it out and finance it separately. So let's just say our affordable housing has been forward funded. I can choose the affordable housing revenue group and the affordable housing build cost group. And now everything that's left within the appraisal for financing is only the open market elements. So now what that's done is it's changed our facilities, and it's meant that here you can see that the forward funding has stripped this out separately. So we've got 2 million, and here you can see the forward funding has been separated. So now we have our forward funding, and then we've got our development finance that's covering the open market element of this development.